In this video, we'll be concerned with market analysis. Market analysis is a tool used to assess the attractiveness of a market and its industry. So it's looking at how successful a market is, how successful its products are, and also the satisfaction levels of its customers. So we're looking here at the competitive situation, essentially, within the market system that generates satisfaction for customers and enables companies to compete effectively with each other. It's conducted alongside macro and micro environmental analysis. By macro, I mean something like PEST. That's the political, PEST, political, economic, social and technological issues associated with a particular company. That's the subject of a separate video. But it also looks at the micro, which could be a SWOT analysis, of strengths, weaknesses, opportunities and threats analysis. So market analysis is conducted alongside of these. It may be wider because it may take in wider information and discuss this in broad terms. So although it may use, say, a PEST and a SWOT analysis, it may also contain, say, a report on the nature of the competitors and the nature of the market and customers and so on. It's important to assess market attractiveness. The analysis determines the current and future opportunities and threats of an industry. So it's important for a business to be able to look at market attractiveness, to see how well it's positioned in the market, to deal with competitors and also to satisfy customers and to achieve its own corporate objectives, perhaps to achieve higher rates of growth or stability or innovation, or to enhance its reputation within the marketplace. Organizations can use this information to assess their strengths and weaknesses. As I said earlier, for example, a SWOT analysis. So the organizations pick up on various points that have been determined from research about the market, about the customers, about the competitors, about the rates of technological progress and within the industry, the technological change, about factors which determine the demand for the product and the sensitivity of the demand to changes in incomes within the area or sensitivity of demand to changes in prices. So market analysis is a very important decision tool for companies. It enables the management of companies to get a quick perspective of the market and the trends in the market. Now, the dimensions of market analysis. Well, David Acker identifies the following as dimensions of market analysis, and I'll set these out now just in headings, and then we'll spend the rest of this video looking at each one in turn. So the first one is market size. So we'll look at the importance of market size, the market growth rate, we'll have a look at that, and market profitability, industry cost structure, distribution channels, market trends, and key success factors. So we've got a list here, and in the rest of this video we'll go through each of these and add a few comments about them and get an understanding of their importance in the context of market analysis and understanding the market. So we'll start with market size. The attractiveness of a market is determined by market size. Sales volume determines market potential and future sales growth. Clearly, the bigger the market, the more attractive it is, the more potential for sales there is within the market. And also, companies will have more scope to compete, to innovate, to modify the product, modify designs, be creative, and to compete with each other in a manner which is conducive to the growth of the market. It'll bring in more customers. Customers will see the products as good value because the companies are fighting to satisfy the customer's requirements. But market size, the bigger the market, the more opportunities there are for companies to grow and to prosper. So the attractiveness of the market is enhanced by its size. The bigger the size, the better it is as far as the companies are concerned. The assessment of market size provides an organisation with a view of current market strengths and whether the market should be exploited. Clearly, if the market is very small, the company may think it wants to leave that market. It wants to leave it alone. Don't get involved. It's too small. The market is too small and it's too risky. If a competitor were to enter a small market, then there may not be enough customers within the market for the two companies or for a small number of companies. So it may be better to enter a large market where there are more opportunities and better chances of survival. Market size can be determined by the following sources of information. Say government data, financial data, customer surveys, and trade unions sometimes publish information about markets as well. So there are secondary sources of information. These are all secondary sources of information. There may be opportunities to pick up primary sources of information through perhaps direct questionnaires to customers and talking to potential customers within markets. But it's important to gauge the size of the market, and individual customers may not know exactly the size. They may be able to guess it's a big market, or it's a market that's currently not exploited or not served by the business community, but their opinions may be not accurate. So dealing with customers for primary data may be problematic. So the chances are the companies will go for secondary data, like government data, financial data, and so on, which is published, and they can try to work out whether it's worthwhile entering the market based on its size. The pace of a market's growth can be examined by analysing historic data to predict future growth. Well, this is a standard technique often used by statisticians and by economists. They pick up data about particular markets, look at how the sales within that market has grown over a particular period, and try to extrapolate that growth rate, try to move it into the future and to make estimates of what's going to happen in the future. It's not completely reliable. Data can suddenly turn down. If the trend is upwards, and therefore statisticians and economists may believe that it's going to continue upwards, it may actually turn down, which could be a disaster for decision makers who want to invest in a growing market, and suddenly the market has peaked and is now turning down. That could be a disaster. So decision makers must look at projected future growth rates with some circumspect. They should be careful about using projected growth rates. So looking at the growth rate of a market is all very fine, but it's historic data. It's looking back at what happened last year, the year before, 6 months ago, or whatever. It's when they start looking into the future it becomes very problematic. Other methods of assessing market growth rate can be used as indicators. For example, the adoption model and the product life cycle. The adoption model, how fast are ideas adopted and how fast does the market respond to new ideas. That may indicate a growing market. Or you could look at the existing products in the market to see what part of their product life cycle they're at. Are they at the mature stage or in the declining stages? Or are they still in the growth stage? So if you look at existing products in the market and try to determine whereabouts in their life cycle are the products, it may be an indicator as to the future of the market. It may mean, for example, if the products are in the declining stage and the companies are not planning to bring out new products, that there is something wrong with the market. The existing suppliers in the market are not going to replace the products when they eventually decline. They're not going to try to engineer demand, try to generate new demand for a modified product. Perhaps that product has run its course, so there's no point in new investment in that market. The adoption model can be a good measure of market growth. The model can be used to outline the rate of adoption on similar products that have been sold in the past. So how fast have products been adopted to the market? Products in the past, how have they been altered and brought back into the market, and were they successful? So it's possible to look at the growth in the market by looking at what models, what products are available in the market, and what's the history of those products, to try and get an indicator of how well the products have been received and what's the likely future demand for similar products. The assessment of a product life cycle is a good indicator of market growth. Product growth, maturity and declining stages can be used to assess market conditions, as I said earlier. So it may be that the product life cycle is a good indicator of perhaps future growth, not stretching far into the future, but perhaps over a short period. They can make projections based on the existing product set in the market and the part of the life cycle that those products are in. For example, price pressure due to competition, brand and consumer loyalty, and the substitute products. So, for example, these are issues associated with the product life cycle. It may be that in order to maintain sales, the existing companies have to cut their price. They may have to cut their price because of competition or because the products are no longer very attractive to generate sales. So that may be an indicator that that market is not worth entering. So even though the market could be quite large, it means customers are slowly turning against that product, and the existing producers in the market are finding it difficult. Market profitability. Well, market profitability is determined by an organization's profit potential. So the profit potential for a business rests on its ability to not just cover its costs, including its opportunity costs, the cost of what it could have done with the investment funds had it not gone into this line of production. It's not just covering that, it's making something over and above. It's making some extra profit. Now, as to whether that potential exists or not is the crux of the matter, and how to work out whether that potential exists is the difficult decision that investors have to make. entrepreneurs have to make. They have to decide whether it's worth entering the market. Profit potential indicates market attractiveness. However, the market will present higher levels of competition. So if a company works out that a certain market has high profit potential, the chances are other companies have worked it out as well. So that in the end, there will be many companies fighting for an existence within that market. Even though the market is big and a company may work out there's high profit potential, but that may be worked out on the basis of that company alone supplying the market, whereas in fact, other companies will also work out the profit potential and join in. So it becomes highly competitive. Sometimes Porter's 5 forces could be used to help to try and work out market profitability. I'm not going to go through Porter's 5 forces here, but just to recap, they look at buyer power, it looks at supplier power, barriers to entry, threats of substitute products, and rivalry. So looking at market profitability may entail a Porter's type analysis of the conditions within the particular market. Now the industry cost structure. Well, industry cost structure is used to identify key factors for success, and organizations can gain competitive advantage by limiting costs. Well, there's always the pressure on companies to try and control costs. Indeed, there are various videos on this course about lean production and just-in-time systems and all sorts of ways in which businesses try to minimize costs, cut out waste. And they may be highly successful in doing this, but there is a bottom line. Once all the costs have been minimized, then if competition is still severe, that company may come under pressure for its own existence. So industry costs are a problem. If all the companies in the market face the same cost structure, then there is a problem for all the companies who are competing within the market. But if some are more efficient than others, then they will survive. It is survival of the fittest. Porter's value chain model can be applied to assess where value can be gained and costs minimized. And that is also the subject of a separate video, so I won't go into it. But essentially, it's looking at the value chain to see where value can be gained and costs minimized, trying to work out how to reduce costs and how to gain value. Strategies can be formulated to cut costs and find efficient means of conducting business activities. As I said a moment ago, JIT, just in time, and lean production, the whole Japanese view of quality and doing the job correctly but doing it once. Now there are various videos in the course that look at this, and it's important to be aware of these, but it all comes down to trying to cut costs for survival and to generate a profit. Clearly, the more competitors that exists in the market, the smaller the profit margin for each individual producer. So it is survival of the fittest. Now, distribution channels. Well, distribution systems are a good assessment for market analysis. Current and existing distribution channels can be assessed in terms of their effectiveness in delivering to customers. The distribution channels simply means how does the company move its product to the final customer? Does it go through warehouses or retailers, or does it go directly to the customer? What are the distribution channels? New and emerging channels offer competitive advantage. So, for example, using, say, online sales, where customers buy directly from the company and the company is able to dispatch directly to the customer using, let's say, logistical systems offered by third parties. So they don't have to run their own fleet of vehicles to deliver the product. They use third-party delivery systems. So they employ someone else, they outsource it to someone else to deliver the product. But of course, they're able to save on the markup that the wholesaler would have made in the past, or the retailer would have made in the past. So if that is the trend within some sector, within a certain market, then some companies who adopt it will gain a cost advantage. So looking at distribution channels may be an indicator of the way in which a particular market is moving. Certain channels have more power to influence the buying decisions. For example, retailers and manufacturers. When retailers are involved, the retailers, it depends on how the retailers market the product. If the retailers buy the product and don't put it at the front of their shops, put it at the back of the shop, there'll be less sales. That means the company is vulnerable, not because of its own fault. It's vulnerable because the retailer chooses to put its product somewhere else in its shop where customers don't get to see it fully. So the manufacturer is punished by the retailer. Not deliberately, but punished nonetheless. So distribution channels are an indicator of the way in which markets are changing. It may be the way around this issue for dealing with retailers is to sell directly to the public, sell online to the public. Market trends. Well, markets are constantly changing and are open to opportunities and threats, which can have a major impact on market size. We live in a dynamic world. It's not one where markets are fixed for all time. Markets change. Products are modified. We live in a globalized community. Globalized in the sense that products can arrive in from any part of the world and compete effectively in the market. So that domestic producers have to fight for an existence against competitors from the other side of the world. Now, this could be a trend in the market, a growing trend in the market. There's more products coming in from low-cost countries. And that may pose a problem for companies. Market trends are industry dependent, and changes in the economy, in social, legal, political, technical, price sensitivity, customer demand and buying patterns influence the market. So all of these different issues affect the company. So it's very difficult to work out market trends. Changes in the economy. Well, that's how the government manages the economy and looks at different patterns of international trade. The exchange rate, and looks at interest rates and looks at investment and taxation and fiscal policy. The social structure and how it changes. Fashions, trends in society. Looks at all of the various issues. So working out market trends is extremely difficult. Market trends determine market attractiveness and future demand. The trends, when they're worked out, are an indicator of how attractive a market is. But as I said in point 2 on the screen, it's very, very difficult to work out market trends. There are so many problems encountered when trying to work out a trend. So many issues need to be taken into account. But if it was possible to work out the trend, then of course that's an indicator of market attractiveness and of future demand. That's if working out the trend was possible. Success, key success factors. Well, success factors allow an organization to achieve their objectives. When they're able to do something successfully, then they can achieve their objectives. Now, what I mean by that is if they're able to set targets, let's say for production, and meet those targets, if they're able to set targets for efficiency or cost. In other words, they have key performance indicators, and if they're able to achieve those key performance indicators and their targets, they're able to achieve those, then they're in a position to compete effectively. Success factors change over time with market conditions and trends, and these may include resource capabilities. So the business is constantly changing. It has to change to keep up with changing requirements from the customer and also changing patterns of competition. As I said earlier, companies are increasingly facing globalized situations, globalized markets, imports from cheap countries that are able to undercut the domestic producers. So the success factors may be looking at resource capability. How well can a company use its resources, and what are its resources capable of doing? Are they flexible in the face of changing customer demands? Can the production be switched over quickly and easily to some modified product? Can the resources be changed? Or is it that they're locked in to making the single product, and that product may be going out of fashion? Can they achieve economies of scale? If it's a large market, if a company grows, it may gain an advantage over its competitors by economies of scale, by economies of size. It's able to buy raw materials at a better price. It's able to negotiate more favorable terms in the bank. It's able to train its workers better. It's able to buy specialist machines that are more productive. But it critically depends on the nature of the market, of the competitors, and how well equipped the competitors are. They are also aspiring to gain economies of scale. And also access efficient distribution channels. It's important that the company has efficient distribution channels. It's able to get its product to the customer. It's able to perhaps sell online, as I said in one of the earlier slides, or it's able to distribute to wholesalers or retailers, and it's able to get its product promoted efficiently once it's been distributed. But it's important to have efficient distribution channels. It's part of the overall cost structure. And also technological advancements. So the market trends and market conditions depend on technological advancements. As the competitors to a company find new ways of producing and get access to better technologies, competition will become fierce, and companies will have to fight to try and adapt the technologies fast, implement them fast, have training programs for their workers, and make sure that they're able to use the new technologies efficiently and effectively. But that is a constant pressure on business, mostly driven by customer demand. Customers want new products. They want more efficient products, longer lasting products, more durable, more interesting, better designed, better value for money. So there is a constant pressure on business to fulfill those aspirations on the part of the customers. So these are some of the issues that must be taken into account when looking at market analysis. It's difficult to pick out which one is the more important. They're all important. I suppose that's the answer. But looking at market trends seems to be a particularly problematic area, and one which is the subject matter of other videos in the course. But statisticians and economists who are very keen on trying to work out trends and make projections, they admit that there are increasing uncertainties as we get past the present time. As we move into the future, the probability of getting it wrong increases. So therefore, the problem of using market trends is an issue, and it's more so an issue for companies who may not have the expertise or the resources to use sophisticated models to try and predict future demand. But that's all I'm going to deal with here. These are important issues, important factors in looking at marketing analysis and looking at how markets are assessed and appraised from various perspectives, mostly from the marketing perspective. But these are important points and worth noting. So it's worthwhile going back over the video, making your own notes and doing supplementary reading. That's all I'm going to deal with at the moment, so let's leave it at that and say thank you for watching.